So if you're thinking about buying a condo or a townhome in the San Fernando Valley, there's a risk hiding in plain sight that could cost you thousands of dollars. And in some cases, it could even hurt your ability to sell later. It's not the kitchen, and no, it's not the flooring, and it's not even the monthly HOA dues by themselves. It's insurance. Right now, the HOA insurance crisis here in the state of California is quietly putting the pressure on condo communities all across the state, but especially here in the valley. Today, I want to walk you through why this matters and how it affects home values and what every buyer and owner should be looking at before they make that move. I'm Frank Spencer, and if you've been watching this channel for any length of time, you know that I believe the smartest real estate decisions are usually made before the crisis shows up. And when it comes to condos and townhomes, one of the biggest issues buyers are overlooking right now is the financial strain many associations are facing because of insurance. This is especially important at a time when more buyers are turning to condos and townhomes because single-family homes have become so expensive. In the greater San Fernando Valley, the median price of a single-family home is around $1.15 million. That means more first-time buyers and more downsizers are looking at attached housing as their most practical option. But affordability at the purchase price does not always mean financial stability after closing. For years, many HOA communities operated with relatively predictable insurance costs. They built budgets around those numbers, they set dues accordingly, and in some cases they deferred maintenance or avoided major dues increases just to keep the homeowners happy. Then the insurance environment changed. Premiums rose dramatically, and in some associations the increases were not mild, they were quite severe. What had once been a manageable operating cost suddenly became one of the biggest pressures on the entire community budget. And when that happens, associations are forced into a corner. And they really only have a few options. They can raise dues, issue a special assessment, delay maintenance, or a combination of all three. None of those options are attractive, and all of them can affect value. A lot of buyers look at condos and ask the obvious questions. How many bedrooms? How does the kitchen look? And what are the dues? Those questions matter, but the deeper question is this. How financially healthy is the association behind the property? Because when an HOA is under financial pressure, that pressure eventually finds its way to the homeowners. Maybe it shows up as a large special assessment. Maybe it shows up as a sharply increased dues. Maybe it shows up as deferred maintenance that makes the entire complex less attractive over time. And maybe it shows up when it's time for you to sell because the next buyer sees the financials and just says no. This is the part many people miss. Insurance does not just affect the HOA, it affects buyer confidence, and buyer confidence affects value. This is where reserve funding becomes incredibly important. Every HOA should have a reserve account and that reserve account is meant to fund future capital expenditures. Think roofs, paint, wood repair, fencing, pool resurfacing, and other major common area components. In other words, it's the community savings account for predictably large expenses. Now here's the problem, and I'm seeing associations in the valley with reserves funded at less than 10% of future needs. Less than 10%. That's not just weak, that's dangerous. Because when insurance shock hits a community like that, there's very little cushion and not much the board of directors can do. The association has no room to absorb the blow. And that's when the owners can get hit with major assessments. This is not just an accounting issue, it's a value issue. If a complex is underfunded, dealing with insurance spikes, and carrying the risk of future assessments, buyers will notice. Some will walk away. Some lenders may be more cautious, and in some cases, the project may not qualify for certain financing programs if the financials don't meet the minimum standards. For example, government-backed programs like FHA and VA often look closely at reserve funding and overall project stability. If the association does not meet those thresholds, your future buyer pool can disappear. And when fewer buyers are eligible to purchase in a community, that can put pressure on resale value. And that's why I always tell buyers, you're not just buying the unit, you're buying into the financial health of the entire community. So let me give you a practical example. In Rock Point, here in Chatsworth, California, our HOA reserve funding is around 45% right now. And all major capital expenditures like roofs, fences, paint, and woodwork have been completed recently, and that matters. When the insurance crisis hit Rock Point, they had enough financial strength to absorb much of that initial shock. And for the first time in its 50-plus year history, the association did issue an assessment, but it totaled only $2,000 over a 2-year period. Compare that with other communities that were facing assessments in the tens of thousands. The difference isn't luck. The difference is financial preparation. And a well-funded association, well, they have options. A poorly funded one can only react. And buyers need to understand the difference. What buyers should review? Well, if you're thinking about buying a condo or a townhome, here are the 3 things I would strongly encourage you to review. First, the budget and the reserve study. You want to know how well funded the reserves are, what major projects are coming, and whether the association is planning responsibly or simply reacting. Most buyers never read them, but the second thing you should be considering is the CC&Rs. That document tells you what the association covers, what you're responsible for, and how the master insurance policy is structured. And that matters because you need to know whether the HOA policy is walls in or walls out. If it's walls in, the association typically covers more of an interior restoration in a catastrophic loss. If it's walls out, you may be responsible for everything from the bare walls inward, which means your HO6 policy needs to be written correctly. Third, rules and regulations, parking restrictions, pet rules, rental restrictions, use of amenities, maintenance obligations. All of that matters more than people think to the community lifestyle. But specifically on the insurance side, I would also encourage condo buyers to look into a special assessment coverage on their HO6 policy. In my opinion, humble as it may be, adding at least $50,000 in special assessment coverage is a smart move. It may cost a couple $100 a year, but if a major assessment ever hits that rider can make a very, very big difference in the quality of your life. Condos and townhomes can absolutely be smart purchases. For many buyers, they're the most realistic path to home ownership. For others, they're a practical downsizing option that still allows them to stay in the neighborhoods they love. But attached housing requires extra level of diligence. With a single-family home, most of your risk is easier to see. With an HOA, some of the biggest risks are buried in budgets, insurance policies, reserve funding, and governing documents. If you ignore these things up front, you may end up paying for them later. So if you're thinking about buying into an HOA community, don't just fall in love with the house, the condo, the unit. Look closely at the association behind it. Because in today's market, the financial strength of the HOA can have a direct impact on your monthly costs, your future resale value, and your peace of mind as a homeowner. So if you found this helpful and you care about making smart real estate decisions here in the San Fernando Valley, I post weekly videos covering market updates, local insights, and real strategies designed to help homeowners and buyers succeed. If you're thinking of selling, I wrote a great guide called Avoiding a Failed Sale: How to Sell Smart and Walk Away Without Regret. You can download it for free at www.mrchatsworth.com/ebook. And until next time, I'll see you around the neighborhood.